This material is from the book, The Management of Consumer Credit. I am here to explain Chapter 10 and concept of credit risk. The provided text discusses the concept of provision in the context of managing bad debts in financial organizations, particularly in the area of consumer credit. Here are the key points. Definition of provision. Provision is an amount set aside against future bad debts, accounted for in the present. It is analogous to depreciation, representing the expected loss in the value of outstanding loans. Purpose of provision. A recognition that the asset value of outstanding loans reported on an organization's balance sheet is less than the stated amount. It serves as a precautionary measure to anticipate future losses due to bad debt. Calculation and estimation of provision. Calculated at the beginning of each financial year based on estimates of the level appropriate for the portfolio of debts. Regularly revised, monthly or quarterly, to update profit and loss forecasts. Provision is an estimate, not a known quantity. Impact on profit. Changes in provision impact profits. An increase in provision results in reduced profits, and a decrease may improve profits. Release of provision. When a debt that has been provided for is written off, a corresponding amount of provision is released. The total value of provisions is reduced by the amount originally set aside for the written-off debt. Roll rate models for provision. Roll rate models estimate provision based on the value of debt at different arrears statuses and the roll rates between these statuses. Segmentation of the portfolio can lead to more accurate provision estimates. Advanced models of provision. Markov chain. Models and scoring models are mentioned as more advanced statistical approaches for provision estimation. Markov chain models can handle situations where accounts can roll to different unconnected states. International Accounting Standard, IAS 39. IAS 39 provides guidelines for accounting for impaired loans. Provisions for impaired debts are calculated on a net present value basis using the contractual rate of interest. Capital requirements and Basel II. Basel II is an international accord defining the minimum capital requirements for deposit-taking institutions. 3 pillars: minimum capital requirements, Pillar 1, regulatory response, Pillar 2, and disclosure, Pillar 3. Pillar 1 focuses on the calculation of capital requirements to cover unexpected losses in credit portfolios. In simple words, Basel II has 3 main parts. Minimum capital requirements, Pillar 1. This is the minimum amount of extra money a company needs to keep to handle unexpected losses. It's like a financial cushion. Regulatory response, Pillar 2. Government regulators check if companies are calculating their risks and the need for extra money correctly. They might ask a company to keep more money if they think there's a risk the company hasn't considered. Disclosure, Pillar 3. Companies have to share information with the public about how they calculate risks and the extra money they keep. It's about being transparent. So, in essence, provision is about estimating expected losses, and Basel II is about making sure companies have enough money for the unexpected, all to keep the financial system stable. Here, the Chapter 10 completed. Now we will discuss the topic of credit risk, functions, responsibilities, and criteria. Credit risk, function, responsibilities. 1. Customer identification, marketing phase. Work with marketing to pinpoint individuals who might pose a credit risk. Exclude these individuals from direct marketing efforts. 2. Customer acquisition, credit decision phase. Determine credit worthiness using credit scoring or judgmental decision rules. Set specific terms for credit offers based on credit worthiness. 3. Account management. Regularly review terms of business, such as monthly credit limit reviews for credit card holders. Implement, track, and monitor accounts in terms of revenues, write-offs, provision estimates, and overall contribution to profits. 4. collections and debt recovery. Design strategies for collections and debt recovery plans when accounts become delinquent. Collaborate with operational teams responsible for collections and debt recovery processing. 5. Fraud prevention. Devise strategies to identify fraudulent applications for new credit and transactions for existing credit, particularly for revolving credit facilities. Integration challenges. Overlap with marketing. There's considerable overlap between marketing and credit risk functions. Integration is logical for common business objectives, but many organizations keep them separate, leading to potential conflicts. Risk response. Paradox. Marketing aims to acquire a certain number of new customers, while credit risk aims to keep bad debt below a specified amount. The risk-response paradox highlights that those most likely to respond to credit offers may be high credit risks, and vice versa for low-risk individuals. Optimal strategy. Balancing act. To strike an optimal strategy, it's crucial to target individuals who respond reasonably well to promotional activities and are acceptably creditworthy. The challenge lies in finding a balance between marketing goals and credit risk objectives. Credit criteria, creditworthiness, assessment, determined through credit scoring or judgmental decision rules. Considers factors like payment history, outstanding debts, credit utilization, and other financial behaviors. Terms of credit offers, APR, annual percentage rate, may vary based on creditworthiness. Less credit-worthy individuals may be offered credit at higher APRs. Account management, regular reviews of credit limits, payments, and overall account behavior. Adjustments based on financial performance and risk assessments. The credit risk function is responsible for evaluating individual customer profiles to make decisions about their credit worthiness and potential contribution to profit. This involves working with the marketing team to identify potentially uncredit-worthy individuals and excluding them from direct marketing efforts. During customer acquisition, the credit risk function decides who is creditworthy based on credit scoring or judgmental decision rules. For creditworthy individuals, the credit risk function determines specific credit terms, such as interest rates. Throughout the account management phase, they regularly review business terms, including monthly credit limit assessments. The credit risk function implements, tracks, and monitors accounts, considering factors like revenues, write-offs, provision estimates, and overall contribution to profits. They also design collections and debt recovery plans for delinquent accounts and develop strategies to identify fraudulent credit applications and transactions. While the objectives of the marketing and credit risk functions overlap, they are often structured separately. This can lead to conflicts if their goals are not well managed. For instance, marketing may aim to acquire a specific number of customers, while credit risk aims to keep bad debt within a set limit. This creates a risk-response paradox, where those most likely to respond to promotional activities are often the least creditworthy, leading to potential default risks. Achieving an optimal marketing credit strategy requires targeting individuals in the middle, responsive to promotions and acceptably creditworthy.